Good morning and welcome to the Daily Energy Markets podcast. It is February 22nd, Thursday, February 22nd. It's all twos on the board then, two, ahead of what do they call those years? A leap year, 29 days. So we get more twos. Oil prices trading this morning, Brent crude oil at 83.29. Been a very steady, tight band with tight in this week after a recovery last week and the consolidating of that sort of position over the last few days, and some of the volatility taken out of the market. The question is, I suppose, ultimately, where does it go from here? Where does this market get direction? Paul Hicken, editor-in-chief at Petroleum Economist, sitting in Riyadh today. Your thoughts, Paul, on what this market does to break out of this rather tight range it's currently in?
Yeah, it's a great question, Sean, and thanks for having me on again. It really is a market gripped by uncertainty, and that uncertainty is keeping it exactly where it is. I think you've probably got a couple of factors which could break it out of its range right now, which is, first of all, is the fundamentals, where the picture of demand is going to go. I was at the IEF event in Riyadh the last couple of days, and there is a massive disparity between the IEA and the OPEC forecasts, 1 million barrels a day in demand gap. I think it reflects partly the uncertainty over China. We all know about its problems in China and where it cut its mortgage rates, and where that demand picture is going to go. The US, you've been talking about this for some time. What's the growth story in the US has held up, what's that mean for interest rates? And so the demand.
Was there any discussion in Riyadh in the sense of the gap between IEA and OPEC? Did they defend their corners? Did OPEC give an explanation for their bullishness and IEA for their bearishness?
No, it's tricky because they didn't really go into detail about the actual methodology. I think the fact is if you look at the long-term forecast, you could talk about maybe some ideology, both maybe arguably talking their book a little bit. But in the short term, I think it's harder to talk about that. And I think it's really reflective of, there's indicators all over the place about whether there's potential economic weakness, how long interest rates are going to go. And I think the macro picture is still uncertain, and I think the market feels that. And I think they're keeping things exactly where it's at. And I think on the geopolitical side, I think you've got the same kind of issue. We talk about this $1, $2, $5 risk premium in the market, but no one wants to push the market any further because it's an irritant to the market, but it's not a disruption from volumes or even flows. So not in that. I think one probably wildcard factor that probably could change the market dynamic is probably around sanctions with Venezuela and Iran. I think they're the things that are looming in the background. But you've got to say that OPEC Plus has done exactly what it said it would do on the tin. It's keeping prices stabilized, and it's provided a floor to the market, even it's at some cost to OPEC, given the extra cuts it's had to put in place.
Well, let's go to Jamal Qureshi, Managing Director, Analysis and Strategy at Petrologistics, sitting in the non-OPEC plus oil-producing country of Norway, so enjoying all the fruits of OPEC Plus's labor without having to make any cuts. Jamal, your thoughts and outlook, and Norway is one of those non-OPEC plus countries adding capacity, sort of keeping a somewhat of a dampening reality on the oil price. Your thoughts on the direction of travel for this market and anything that might break it out?
Well, I don't take a specific view on prices, but that's not sort of what we're in the business of doing. But what I can say is, in following the flows, especially on the supply side, the ability of all of OPEC plus, but especially the core players, to, even in the midst of maintaining some ambiguity, and I'm thinking specifically on the non-OPEC members, that they have managed to really maintain flows at a level that doesn't spook the market, right? And that still maintains their optionality in terms of direction, where they want to go on their supply. So as we've seen some of the data become more opaque, you know, at the very least, we've been able to go in and back into the numbers with a pretty high degree of accuracy and see that when they say that they are going to be maintaining levels which they're getting fuzzier about on the details, they are still managing to put out actual numbers on supply that are balancing sort of where they want the market to be at present. So if we look at
what about
Russian,
Norway in the context of its ability to continue
Sure.
to add new capacity? Is that something they're committed to? Do they have the opportunity to?
Well, it's funny because Norwegian politics is I mean, as it always has been to some extent, but it's obviously very torn because you've got issues now that go beyond oil that are driving things. So you've got deep sea mining, for example, in the Arctic, that's become a major question whether that's going to be permitted, and they're moving forward on that. And we're seeing that on the oil development side as well, sort of blocks in the north. So short answer is, yeah, they're thus far willing to move forward. So I would expect that while the battles will continue to be heated, for the time being, those plans are moving ahead.
Let's go to India, which is the sort of positive story on the Asian demand side. Vibhuti Garg, Director South Asia at the IEEFA. Vibhuti, obviously the China narrative remains sort of generally tone negative, neutral to negative, let's say. Even though, you know, it's had a pretty good New Year holiday and so forth. But India is where people are turning to for the sort of the positive narrative, the bullish narrative. Will India disappoint this year after the election? All the freebies will go away and India's reality will sober up, or is this a train that's surging on? Your thoughts on the outlook for Indian demand beyond the election?
As you said, that India is exhibiting a very strong economic growth. So I don't think so. Even after elections, the demand is going to go down. And so even after the freebies go away, there is a huge demand, which people now, because of high rising income as well as a standard they want to maintain. So if you look at the growth in the sales of vehicles, while now we are increasingly seeing more electric vehicle sales, but still the normal ICE vehicles growth is tremendous because now there are more and more people demanding for it. And also on, you know, the refined products, maybe the diesel demand, yes, will go down, not because of election or no election, but just because we have now got good alternatives to diesel. And India, being strong on climate ambition as well, want to reduce its demand on diesel. But as far as LPG is concerned and other refined products are concerned, I think there is a strong push from the government to continue. So that demand will grow. And moreover, India is poised to, you know, also have an export-led kind of a refining products, and it wants to increase its share of refined products. So that means even if most of the oil demand may not be then consumed domestically, but they do have a big demand for refined products. So I feel internationally, which they export. So I don't see the demand going down anywhere soon.
I wanted to take the opportunity not to miss out on the sort of ticker parade euphoria around this company called NVIDIA and AI. And as it was sort of drowning us all in the last 24 hours, and now we're seeing the Japanese Nikkei index hit a record today, 30 years, and it's moving and moving. And generally, the narrative is it's surging on the back of the sort of the dawn of the age of AI, which was sort of pronounced yesterday by the CEO of NVIDIA, and all those tech companies in Japan seem to be on the winning train. I wanted to, Paul, get your thoughts where one can. Is this dawn of the age of AI bullish or bearish for the oil outlook for oil prices, oil demand? No answer. Or he's muted. Maybe that's the answer. We're all muted by AI.
Sorry,
Yeah,
sorry,
yeah,
sorry,
yeah,
Sean. Yeah,
yeah.
sorry, I
No
had a problem with
problem,
my
no
mute
problem. We'll have to get your AI clone on next time. He'll never have
Yeah,
that problem.
probably do a chat GPT Paul will do a better job, maybe. This is actually a big question for actually energy demand, because the amount of electrification that's going to be needed, digital mining. I think it's an energy consumption question, and I think this was one of the discussions we were having this last couple of days, which is the amount of energy going to be needed in the next 2 decades when we talk about long-term like transition questions. And Saudi Aramco was talking a lot about its transition plans and how much it's committed to an all energies approach. Really genuinely, Prince Abdulaziz was really talking up the sort of big energy plans they have, all energy plans. And I think the scale of the electrification that's potentially needed, and what's going to be needed there, it's going to put a massive strain on resources, and that includes all around. I think there's a real risk of a danger of this idea of cheap energies could be gone for forever, and I think it's something that's not really being looked at as closely as possible.
Jamal, your thoughts on that? I mean, AI being bullish for oil. I mean, I can see electrification and all those data farms. I mean, my God, they're going to have to get a lot more efficient than they are. That's for sure. But nonetheless, the flip side of the argument Paul is making, AI, like other tools, digital tools, deliver incredible efficiencies. The amount of GDP needed, or energy needed to make a module of GDP growth, one would expect decreases. So I'm just wondering, from that side, is the dawn of AI bullish or bearish for oil prices in your opinion?
I personally am more on the side of the incredible leaps this is going to make in energy efficiency and optimization of energy systems as well, including transport systems. Speaking of sort of the infrastructure backgrounds, in addition to anything on actual sort of vehicles, the ability of the opportunity to balance out the increased consumption is, I think, further strengthened by the fact that so many tech companies are focused on net zero targets within their own operations. It's not to say everybody's going to be hitting that by any means, but as that compute demand increases, we also see a desire on the part of many of these companies to match that up with greater efficiency and green energy behind it. So, I think we're at a point in time where the energy transition is not just about switching over how sort of we power the world, but also as the changes occur and the new frameworks are set in place, being able to do that in extremely efficient ways. So, short answer, I actually think at the end of the day, this is going to be something that will reduce net fossil fuel demand, at least, and accelerate sort of green energy usage in the process while reducing per unit of GDP the amount of energy required, as you said.
Vibhuti, your thoughts? I mean, obviously, Asia seems to be potentially one of the big winners here. I mean, in terms of the ability to accelerate its technology development. What's its outlook for India? And you think an India's growth story, which is sort of also the dawn of India, so you have the dawn of AI and the dawn of India at the same time. And obviously, India is a massive technology center as well. The outlook for AI impacting hydrocarbon demand in India going forward.
Yeah, India really has a big ambition on hydrocarbons. So the efficiency that will come with the technology innovation will definitely have a big impact. But on the other hand, if you'll see, India also has a big push on biofuels. So we have started blending ethanol with petrol. So we have already achieved target of 20%. There is an ambition to raise it further, so which will drive the demand for oil down because there are technology innovation in terms of blending more and more with ethanol going forward, because India is a big importer of oil. And while the prices have softened a little and our import bills have gone down in the last 1 year, but going forward, I think the strategy for India is to reduce oil consumption, because it's the first time after so many years they've been able to reduce their current account deficit and are in a more, in a better position as far as the economic growth is concerned. So I think definitely efficiencies will drive the demand as well as other targets, because India definitely has a big focus on biofuels as well.
Let's take that into the survey question for this morning on where the rest of the room and post on social also take a view on this dawn of AI, and will the era of AI be bullish or bearish for oil prices? It's kind of a big idea question. It probably has too many contours to sum up in one answer, but nonetheless, just for fun, we will do so this morning. The dawn of AI at the same time around the dawn of climate consciousness, the dawn of energy transition. Are all of those aligned against hydrocarbons opportunity, or do they put wind in the sails of it as well? That's the question that we're looking at this morning, not to be left out of the ticker parade, as I said. Paul, I wanted to get your thoughts on the idea of new supply. We talked a little bit there about what that might look like in Norway, but ultimately, your meeting at the IEA, you're still in Riyadh, the OPEC plus 2.2 million barrel a day demand growth for 24 versus the IEA, which is 1.2 million barrels a day of demand growth. And yet we see non-OPEC plus supply continuing to grow after a pretty strong year last year. How did that narrative come up in Riyadh, if indeed it did, i.e. non-OPEC supply growth? Why are we giving up market share to them? Or where do you think that goes through the rest of 2024?
Well, I think, first of all, I think OPEC doesn't look at they don't talk about, they talk about just balancing the market and about where price, not where price should be, but where the market should be, and providing balance. So they don't look at how that may impact in terms of specific responses. But certainly there was a lot of discussion around the US, how much more life is in the Permian now. We've seen the consolidation, big shale patch moves, very different to the independent days in the market, and there's certainly a big consolidation. I think what's happened is, especially last year, they used up the DUCs, DUCs, the drilled uncompleted wells, and that's now out the equation. So there's going to be growth, but it's going to be still moderate growth from the US. That seems to be the likely picture. Guyana's still got.
Do you think that with you mentioned there, the consolidation in the Permian, i.e. Exxon and Oxy and Chevron buying up some of the big independent producers in the Permian last year, will that be a trigger for lower investment, for lower growth in production, do you think, rather than more, when you think they have a huge balance sheet, they could bring a lot of money to the ground in that acreage, but you're signaling that you don't expect them to do that?
Well, I think there's going to be moderate growth. I think there's still a conservative approach to return. There's still a focus on returns, investor returns, and there's still going to be but it does suggest that they still care about the shale patch, and there's still life in that shale patch. You're going to see a different type of response to OPEC as a result of these mergers, which is the independents used to be, the marginal supplier. You know, I think the bigger companies won't work in the same way. They'll be a bit more consistent in their approach to supply. And I think what you're going to probably see is a modest but upward trajectory, at least for the next few years, in US shale growth. And you'll see the headlines: record US production as it keeps going up. And anytime it dips, it's going to be is it peaked? But I think there's going to be an upward trajectory for at least the next couple of years.
Jamal, I wanted to get your thoughts. I mean, we look at this new supply and the non-OPEC plus supply that has become so critical for Europe. The US oil now exporting close to 4 million barrels a day, world's largest LNG exporter, savior of Europe, but also Norway. Norway now the biggest supplier of natural gas, taken over from Russia. And my question is, as we kind of get closer, at least, you know, whether it appears, maybe that's a false dawn, but the end game of some description regarding Russia as invasion of Ukraine, not that the invasion is coming to an end, but perhaps the willingness to support the Ukrainian defense is waning. And with that, perhaps we're in the end game. And so we look at where the energy supply architecture of Europe is. Norway, big winner, US, big winner. Does Russia come back? Does Norway get challenged? I mean, how do you see that playing out? We saw, obviously, the Nord Stream 2 pipeline being blown up very early in the conflict with Russia and Ukraine. A big signal of that not coming back anytime soon. But where do you think the bigger game plays out between, does the Europe become increasingly dependent on the US? Should it? Or does Norway become the big winner continuously? Your thoughts on the dynamic in a sort of an end game with the Russian war in Ukraine and the big suppliers now into Europe?
Yeah. I think maybe we have to start at the baseline of how the politics and sanctions regimes have tended to work over time. I mean, put very simply, it's easy to put sanctions on and hard to take them off. That's how Western sanctions have tended to work. And then add to that the fact that there has been such a massive shift in energy flows to something that Europe and sort of the West/global North has been able to get used to, especially Atlantic Basin markets. All of that basically saying that there is sort of a new normal that can be sustainable so long as the politics don't want to change. The conflict is changing. The response to the conflict is changing. But there remains no love lost between sort of the two sides. So now we've got a case where, for example, Russian product flows have found crude and product flows have found new outlets. So places like Brazil regularly take in Russian diesel. Obviously, the large flows to the east on the crude side. A lot more ship-to-ship transfers going on. All of these things are things that can be sustained so long as the politics, fundamentally on sanctions, stay the way they are. I'm going to add one other thing to that too, which is that the product markets, especially for the Atlantic Basin, are shifting very fast with the addition of new refining capacity that will impact sort of the swing basis for products. So West Africa, right, has always sort of kind of been the ultimate destination for products that couldn't find another home, especially out of the Gulf Coast in Europe. And that's now changing massively as the Dangote refinery comes on in Nigeria, as Azor comes on, as more Indian refining capacity comes on. All of this pushes in and creates a lot of competition, which means Gulf Coast barrels have a much more natural home in Europe, while the Russian barrels, because of the politics of it, are fine going elsewhere. So all of that to basically say, there is a sustainable ability to maintain the basic structure of flows, and that structure is actually getting stronger from a market perspective on the product side.
Vibhuti, there was a big, what seemed to be a big story in India this week that passed not with too much attention, and that was India seeking $26 billion of investment in private nuclear power investment. The first time we're seeing the Indian market open up, the nuclear market open up for private investors. $26 billion and to build a fairly significant additional capacity in nuclear. Your thoughts on the outlook for that actually happening and what it means for the outlook for India's fuel mix, energy mix, as you mentioned there, and then you always hear it said, India wants all of the above, but a massive move into greater nuclear power in India. What does that mean for the A, it happening, and B, for the fuel mix?
Well, India has been looking at expanding nuclear capacity from very long, but due to limited availability of fuel and not being able to have strong tie-ups with other nations for the supply, I think the plan had been postponed quite a few times. But given now that India is looking at expanding, energy demand at the rate of 7%. So the belief is, as you rightly said, to have like an all fuel kind of an approach where you want that this incremental demand is being met from all sources, and nuclear, for that matter, is being considered more clean, which, from my institute perspective, may not be the ideal choice. In fact, we can straight away leapfrog and just develop and use that kind of money for building more and more storage projects, because renewable energy on its own, with increasing share, I think we are facing that bottleneck unless we have more and more storage capacity. Increasing share of renewable into the grid becomes increasingly a problem. But as far as nuclear is concerned, yes, government is eyeing on small nuclear reactors and not like big projects because of the issues, the nuclear capacity, but smaller reactors can address some of those issues. So yes, India is looking at expanding more nuclear capacity, but I think it's going to be a wait and watch policy. We have been hearing this news for last so many years, but the progress on ground has been minimal. But with inviting private players as well as so much of investment, so they could be addition, but I personally feel it could be limited and not like a great share of increasing of nuclear capacity in the total energy mix in India.
I mean, just for a note, India's current nuclear portion of the electricity generation is only 2%, and the target, at least for non-fossil fuels, the electricity generation capacity in India, to get it to 50% by not nuclear, but all non-fossil fuel electricity generation, to get to 50% by 2030, which is now currently 42%. But even in that frame, I don't think it's even viable to expect that one could build nuclear power plants over that time, or 6 years would be quite an accelerated path. But nonetheless, worth paying attention to. Big growth industry, big growth economy like India, turning to everything, and obviously fossil fuels still there, but not looking at it as the only answer in the town. Last word with you, Paul. Obviously, you're in Riyadh. We've said that. I wanted to give you the last word on whether you got any strong signals that OPEC Plus would be extending their current output cuts portfolio and all of its voluntaries and non-voluntaries, but the package that is in Q1 will roll over and still be with us in Q2.
I didn't get any indication, but from my perspective, I would say that's looking very likely where prices are at, and they seem very content where things are at right now. So I think it's more of the same for the time being.
And the old caveat, if it's not broken, don't fix it. So there's this bullish sense in the room that AI will be bullish rather than bearish. We'll see if the wider audience on social agrees with that. But we'll have to wrap it up there. As we said, oil prices trading up a little bit this morning in Asian trade, holding on to that sort of $83 handle, which certainly all of the people Paul was meeting in Riyadh would be quite happy. And I'm sure all of the people that are in Norway with Jamal would be very happy with $83 Brent, but perhaps Vibhuti and her colleagues and peers in India may not be thrilled with $83 Brent, and hence looking at nuclear or other alternatives if oil prices are going to be at these levels and higher in the distant future. 80 might be the new floor.
It's better than over hundreds, Sean. So
yeah, it's better than 100, that's for sure, on the consumption side. I think they'd even agree with that at the gasoline pumps in New York and in Oslo and elsewhere. We'll wrap it up there. Jamal Qureshi, lovely to have you join us. We look forward to seeing you again. And Paul Hicken, as always, great to have you, and great to have you from Riyadh. And Vibhuti Garg, thank you so much. And for any of you that are in London next week for IE Week, we look forward to seeing you there. All the best and have a good day.
thank
Thanks,
you.
Sean. See you in London. Take care.
Cheers, mate.